This is episode 88 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 88 of the Andrew Hines Real Estate Investing Podcast. Today, I have, for the second time on the show, Carlo Sorrenti. Carlo originally appeared on one of the episodes in the early 50s. I think it was episode 53. And we talked all about his student rental business, the business that he has for flipping properties. And I had him back on because he was getting some questions from some of his tenants about real estate investing. And I just figured, why not do a Q&A episode, which is a bit different. I've done it one time before on episode 49 with George Doobie for real estate investing general questions and real estate investing in student rental questions. So what we did in this episode is we talked generally about what Carlo's up to right now, what his current strategies are, and then also went through some listener questions. And we got into a talk about the economy. We got into a talk about how to focus energy in times like these and how to stay productive in times like these. Carlo's a very impressive real estate investor. For those of you who haven't seen his previous episode, he has over $20 million in real estate assets. Most of that is held on his own. He's got a fantastic business sense, and he has a way about doing business where there's always a solution. So Carlo's been incredibly valuable to me over my real estate investing career. I really do value that relationship, and I know that you're going to get a lot out of listening to this episode. So on to some other business before we get to the episode. Number one, if you're new to the podcast, I would highly recommend going back to the first 20 episodes because they're very foundational. This podcast has evolved over time, and I don't go into the basics as much as I used to for obvious reasons. Want to keep this moving forward, progressing forward. So if you haven't started off at the beginning, I would highly encourage you to do that. The people who I'm aware of that have listened to or watched all the episodes of this podcast are ones that are taking action. Now, I'm not saying that's causation. It might just be correlation because they're interested in the subject matter, but I do believe that it'll be very valuable because of the great guests that have been on this podcast. So I'd highly recommend you go right back to the beginning, especially for the numbers. You can also grab the cash flow sheet that I use to analyze deals on my website. If you go to andrew-hines.com, you'll see the link there to download the sheet. I've been getting some feedback of people who are interested in learning a little bit more about the economic situation and what the current lockdown is basically doing to us from a real estate standpoint, economic standpoint, and what we can expect coming forward. It's no secret that I'm very troubled by what's going on. You've heard me talk about that on this podcast. The challenge is there are some economics concepts that do need a little bit of a mini lesson. So what I was thinking about doing is maybe a little live stream on YouTube, might be a 1 or 2 hour presentation with Q&A to go over the basics of economics, for people who have no background in that, to just explain the current situation so that you can now use logic and reason to figure out what might be coming down the pipe in your specific areas and then for Canada as a whole as well. So this is me thinking out loud. So if that's something you might be interested in, hit me up on Instagram ideally and let me know. I'm at the Andrew Hines. Just let me know if that's something you're interested in, if there are specific topics you'd like covered. This is just a new idea, like I said, and I would certainly consider it if there is interest there in having something like that done. So without further ado, let's go ahead and get into today's episode with Carlo Sorrenti. I know you're going to enjoy this one. Here's episode 88. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I have, for the second time on the show, Carlo Sorrenti. Carlo, thanks for making the drive up.
Yeah, not a problem. Thanks for having me, Andrew. Nice to be here, catch up with you again.
Yeah, well, we had a good chat last time. We were talking about your student rentals. And so for information purposes, Carlo reached out to me, said he wouldn't mind coming back on. He was getting some questions from some of his tenants who were curious about real estate investing. And I figured I'd put out some questions to my followers on Instagram. So we're going to go over some of those questions today, but we'll do a little bit of a recap of what Carlo does. He is a very aggressive real estate investor, student rental investor, multifamily investor, lot of assets. I think we were talking $20 million in assets last time. And
Yeah.
Things have gone up in value, so that's doing well for you.
That's always nice, yeah.
So rather than me give the story, Carlo, just for those who haven't seen the previous episode, tell us a little bit about yourself.
Yeah, so we won't go into it too much because there's a whole other episode if viewers are interested. But
yeah, episode 53, I believe. Is the number.
Yeah, you're the expert there, Andrew. But more or less, I own a flipping business, and we essentially have a very specific niche where we build homes and fully renovate them and flip them to investors that are looking for turnkey properties. And then what we touched on as well is what I'm more passionate about is actually hanging on to real estate and holding it for the long term. So as you just mentioned, my portfolio, it was around 20 million at that time. Maybe it's gone up a little bit now. And that's just like a long-term plan to hang on to those properties and collect the rental income, which really at the end of the day, the freedom of owning those assets and the long-term equity buildup is what keeps me passionate and keeps me motivated. So
yeah, like I know you're kind of getting to that point where you don't really need to buy anymore, and we've talked about that. You've got cash flow, I've got to imagine, in the 10,000 plus per month, probably more like 15. I'm totally guessing.
yeah, you're not too far off. It definitely is fine, but I enjoy it.
So it's kind of a game, right? The creative element of it too.
I like the thrill of like hunting for a deal. We talked a lot about this last time, but I like the thrill of hunting for a deal, like being involved in a transaction, negotiating with a seller. That's really where I shine, and just that's where I like to spend my time. So I like to delegate out other things, but it's ultimately a passion for me, so it doesn't really feel like work.
Now, let's make it specific to the time of or the circumstances right now, because things have changed a little bit. Are you still buying since the lockdown? Are you still looking at this point?
I'm definitely still looking, but you always really have to adapt, right? Especially with what's been going on during this pandemic. Prices like anywhere in the GTA. So I'm from London, Ontario. Most viewers will have watched the last one, but I'm from London. And right now we're at the end of September. I don't know when this will air, but
a few weeks.
Basically, it's a crazy seller's market right now in London for sure. And I think anywhere in the GTA. So to answer your question, it's been a little tricky to buy projects that actually make sense. So I've been adapting, and I have a new strategy now to buy holds that are a bit higher in price and just operate them as more executive rentals. Because when you go up a bit higher in price, this is just for London anyways, 800, 900, even $1 million, there's not as much competition, and you can definitely get a much better bang for your dollar right now than $400, $500, $600,000 price category. So you always have to adapt, to answer your question, and that's sort of the direction that I'm heading right now.
Yeah, I mean that's the name of the game. Like if you find yourself if you're competing with everybody else, then it's probably time to pause and reflect.
Totally.
And I don't think, like, if I look back and evaluate everything you've done, you've always had an angle, and we've talked about that. You still got your
angles,
angle.
my friend.
You gotta have an angle. I had one of the questions I had, and I remember it. I remember it just because it was like the obvious question. Because I put out this teaser. I'm like, well, this guy's done, $100,000-$200,000 flips profit. You've done burrs where you've pulled all your money out, and $100,000 on top of it. And the obvious question is, what are you doing that not everybody else is figuring out? And I think we've more or less just covered it. But let's just unpack that a little bit more. So you've obviously, back when you were doing the student rentals, one of the quotes that I remember most from the last time you were on is you said, I found a way that I could pay more for a property.
True, I said that, yeah.
Let's recap that a little bit. So give me an example of how you've recently paid more for a property than others would because of what you knew you could do to it.
So I think, or I know, like the rationale behind that quote is having like the best market knowledge. Because if you have the best knowledge about whatever particular little niche that you're in, then you're going to know how to create the most value on that particular property. And in theory, you should be able to pay, the most for that property. So right now, it doesn't even really make a lot of sense to pick up these projects, and I'm adapting to either buying more expensive properties. So there's an example. I'm buying properties I'm targeting properties that are like $1 million in London, which is expensive for London. And I want to buy maybe 8, 9, or 10 of them by the end of next year. And I'm just looking to break even. So that's an entirely different strategy. And the rationale behind that is I know, or I'm confident at least, that those properties are going to have the best appreciation in London in the next, let's say 6, 7, 8 years.
Yeah.
So it's an entirely different strategy based on the fact that I have that really intimate knowledge of the market in London. So I don't think it's worthwhile to pick up properties that are like 400,000, 500,000, 600,000 right now anyways in London, because they're already sort of at their peak. It's not as if they won't continue to appreciate, but from what I'm seeing, they're already at their peak, and they're going to just graduate in value a little less aggressively than the higher price categories.
Well, it seems like there's always this like threshold that people are trying to get past. Like the average home buyer in London probably has a cap at say 650 or 700.
Sure.
So once you get past that threshold, all of a sudden you might be getting an extra 1,000 square feet for only an extra $100,000.
Exactly.
Or something like
the
that.
The bang that you're getting for that additional, let's say 200 grand between 600 and 800, again, in London anyways, I imagine other municipalities would have a similar threshold. It just may differ between cities, but in London anyways, it's astronomical. Like you're getting so much more of a house for a couple $100K more. And that's why I think these properties right now anyways are going to have the best potential for appreciation. So I think it's just always about changing up your strategies and, like you said, having an angle and just being confident in your approach, which actually comes from having that knowledge and studying the market and, just learning always and having that faith that what you've actually learned, you can execute it and be confident in that approach.
That would be the easier said than done part. The faith part is a little harder.
True.
But I would say like a lot of people just put their head down and they're like, oh, well, everybody does duplex conversions. And I've seen it. And they'll do these duplex conversions for a built-in maybe $40,000 or $20,000 of equity when they're done. Theoretical, because if they were to sell it, they'd pay realtor fees and that'd be gone.
Right.
But they'll just keep doing it because that's the only strategy they know of, and they know everybody else is doing that. Whereas I think one thing you've always done is you kind of did that pause and reflect, okay, well, I know my market, but this current strategy doesn't seem to fit. Not right now. Like I remember you telling me that I paid too much for a property that I paid $210 for. A bungalow.
If I said that, it was true at the time. It was too much at the time. Otherwise, I would have bought it, right?
Yeah, exactly. That was the only reason that you hadn't bought it. But now, of course, that same property in that same condition, and I think that was Lexington.
Yes.
So that same property would have been what, for $100,000 as a piece of junk. Now.
Even right now, that same property, and this was only like 5 years ago, right?
That was 2015, yeah.
Yeah, so 5 years ago. So right now, that property in hindsight would be, like about $400K, untouched, unrenovated.
Just like a junky, like old siding.
Hindsight's 2020, right? But just to build on your point on like that example of people doing the conversions for like 20 or 40K. So where I've adjusted now is I'm looking at how, let's just say $1 million house, make zero cash flow a month. You're zero equity right away, but they're like newer homes. But if you can break even on a property like that, and you look at the mortgage, it's going down around $1,500 a month. Just call it 18 grand a year. And then even if you put an appreciation of like 3% on that, which is pretty conservative, 30 grand a year plus the 20 grand that it's going down. Yeah. So 50K a year. You're not seeing that right away, but my thinking is hang on to about 10 of those properties for 6, 7, 8 years. Then you're talking about some serious equity with very little headaches. And it's just a whole different strategy. Well,
and the client you would rent to would probably be a little bit better, right? There's somebody who wants a nice place and is willing to pay for it, probably professionals. So you could probably have a much more hassle-free rental experience versus these duplexes and such. Sometimes the tenants you get are actually like, they're searching for your product because it's the actual most affordable thing they can find. And
it could possibly be the case, yeah.
And I'm kind of experiencing that right now on one of my properties. Is actually a couple of the family stuff in London. It's fine, but they're clearly people who like this is at the threshold for their affordability.
Yeah.
And not always the place you want to find yourself, because then if something happens, you get an email or a phone call saying I'm not going to be able to pay rent this month.
Well, better than anyone that I really don't like that model. Like I go for the higher end assets, really nice renovations and try and get like the highest end of
absolutely.
the market, which
And I do
think
too.
you do as well.
And for whatever reason, I still am seeing it, and it might just be the neighborhoods that my properties are in, and maybe they have a little bit of growing to do, or
Right.
maybe I was a little impatient and I was trying to push for top dollar,
Yeah.
and I kind of eliminated some of the market that would have taken me up on my offer, so to speak.
Now you're going to adjust and readapt and use my strategy that I just told you about.
Yeah. Well, you know what? I'm a cash flow guy. So, and I totally get where you're coming from, because you have such strong cash flow in one place. It's okay to spread a little around and take no cash flow on certain assets because you don't need it. And I totally get where you're coming from there. And very, very rarely would I compromise on cash flow requirements. But for what you're saying, there is a time and a place. So let's just do an example of what that might look like. Do you think you'd rent one of those houses out for like $3,500 or $3,000?
I'm thinking in the low three, like maybe let's say $3,200 plus the tenant would pay all utilities.
Okay, so we'll do an example. So taxes on some place like that, probably like $5,000 or so.
Say $6,000.
$6,000.
Yeah, $500 a month.
Okay, insurance, you're probably gonna be like $2,000 maybe.
Yes, just say $200 a month.
Okay.
$2,400.
Okay, $2,400, and then maintenance, we'll say 5%.
It'd be very minimal.
Yeah, no management, no utilities. You'd have no lawn cutting, and miscellaneous. I just like to leave $500.
Yeah.
So you're talking buying for what?
Let's just say 900.
900,000.
Yeah. So mortgage, you're at like $720K a mortgage.
Yeah. So if you wouldn't get 80%, right? You'd be 75.
Yeah, probably 75
And
realistically.
I think you're typically working with a credit union, so they would want a 25-year AM.
Yeah, 25-year M for sure, which I don't mind because you're paying it down more aggressively.
Right. Okay. And then you've got an interest rate now. Like interest rates are pretty
I'd say low twos.
Low twos. Say maybe 2.5 to be conservative here.
Yeah.
Okay. So based on everything you just said, if you can get 3,200, that's 38,400 a year.
Yeah. The mortgage should be on that like 25 to 2,600 in that vicinity, I would imagine.
I'm showing 675,000 at 75% loan to value, 25-year AM. So you're going to have a mortgage payment of like $3,023.
Should be a bit less than that, you know, because I think you can get low twos right now.
Okay, yeah. So say you can get 2.25.
Yeah.
Then your mortgage payment's going to be around $2,940.
Yeah, and realistically, if I'm paying $900 in London, I am going to get $3,400, $3,500. You know, so it may be within $100 or $200 a month of not breaking even, or some may cash flow $100 or $200 a month.
Right.
Doesn't affect the overall strategy though.
No, and I wouldn't think it would. And I actually think that you might be pleasantly surprised on rents. Like I think you actually, I mean, 3,500. There are people in Brampton, for instance, or people in Mississauga that are paying $2,500 for a basement.
Really?
Depends.
Yeah,
like it
true.
depends. Like you know what I mean. So in context, there's obviously there's room for growth.
Yeah.
But anyways, just looking at this, you might be into a negative a few $100 a month.
Yeah. Yeah. And that's fine.
But like if we want to look at your overall return, which is what I really wanted to break down.
Let's do that.
So your mortgage pay down over 5 years on that 25-year AM would be $108,000. If you said 3% annual appreciation, I don't think that's even accurate. I think it's going to be more.
I realistically think it'll be considerably more than that. That's why I'm buying in this price category. So even if you said 4%.
Even if we just said 3 to be super conservative, and you got the negative cash flow a little bit, if you have to come in with 25% down, pay your land transfer of $14,000, pay your legal fees of like $1,700, you're still 18.4% return on investment.
Yeah, which is amazing. Which very little headaches, very little to no headaches whatsoever.
And your portfolio is still well positive in terms of cash flow.
Yeah, and I like the diversification. And like you mentioned earlier, you're a cash flow guy. I am too, bar none. Mm-hmm. It's like, well, what are you going to do if those don't exist right now? Those deals.
The cash flow deals.
Personally, I'm not just going to sign out.
Well, yeah,
I'm going to adapt and do this.
Right, and it's inconsequential to you at this point. But I mean, the other option is you spread out. The other option is you potentially go to a market, that's 2 hours away, or you can go to Sarnia, for instance, which is a bit of a pain. You'd be driving an hour.
Yeah.
Do you want that headache, or do you care that much?
I don't want that at all. I mean, I think this is a great strategy for me personally, and I think it touches on our earlier point. Like, that's just one mindset that you should have if you're in this field, is you need to always be able to adapt.
Yeah. Well, it's not to say that you couldn't find cash flow or create it, right? I think create it is probably the more likely.
You definitely create it.
Yeah, but this plan isn't a bad one, because I think realistically we're going to be higher than 3%. The main reason I think that is because of inflation. With the way our government is, I mean, we're talking 400 billion, probably more like 500 billion this year deficit spending, which is $500 billion of cash that really shouldn't be in the market.
Yeah.
And then we have the whole money creation thing, how banks lend out, with a 10% fractional reserve.
True.
So 500 billion can turn into 5 trillion through money creation, through just economic cycles.
Yeah.
So that's a lot of inflation.
Completely. And that's like more on a macro level, but even on a micro scale, like within the market that I'm talking about within London, the fundamentals of the city are strong. Like we have a major university, which is growing. We have a major college, which is growing.
Healthcare.
There's significant investment being put in the form of residential complexes, apartment buildings, high rises, significant investment going into the downtown core, major hospitals, an airport, major employers, and the city keeps expanding. The city keeps expanding, both in size, geographically, and in population. So on a micro level, when I study the market and I look at those fundamentals, and then I look even more in depth at pricing, like we touched on earlier, like what has the most capacity to appreciate. Like I'm all in on this price category now, for all of those reasons. And your macro reasons make a lot of sense too.
Well, yeah, it's just going to drive inflation, right? We're already seeing it. The economy is like a sponge. If you don't have more goods, it's just going to soak up the extra cash. And so the extra cash is basically, it's not real buying power. It's fake. It's fictitious. Did you
invent that, Professor Hines?
No, I heard that somewhere.
Okay.
I don't take credit for that.
Okay.
But it does bug me what our government's doing, because they're effectively stealing for all those people, the elderly that like to keep money in their house and under their mattress and in their safe.
The money's being devalued.
Yeah, they're being robbed right now through inflation, and they don't even realize it. So, we're seeing that with cost of construction. It's just going up like crazy. I don't know if you said like 2x4 by $8 right now. 2x4
crazy.
by $8.
I mean, that also played into my thinking.
Yeah.
Right. Like
cost of replacement, right? You can't replace it.
Yeah. I mean, why not pick up these assets, like these houses that are a couple years old?
Yeah.
Don't have to deal with 2x4s or construction or this or that. It's like, it makes a lot of sense right now for me personally.
Okay, so it looks like a pretty solid strategy as far as building a lot of net worth. Like, let's just say, for instance, I mean, 3% is inflation when we're doing things normally. Like, we're not having $500 billion deficits.
Right.
Our interest rates are around 3%. So what our government has done is they basically injected a whole bunch of cash and lowered our interest rates.
Yeah.
Taxes are temporarily lower too, although that's really just delaying the inevitable. Okay, so we've got all that going on. So let's just say, for instance, you hit like say 6% inflation. Now all of a sudden your return is bumping up to 30%.
Yeah, which I think is totally plausible, which is why I'm doing it.
So that's 54 in context. That'd be $54,000 of increase in price over the course of a year. We've seen that in London on houses, say in the 500-600 range.
Exactly.
In the last 5 months.
That's certainly a year.
Yeah,
certainly
in the last year. Yeah, so it's very reasonable, I would think, to expect that. Of course, we don't know for sure, so we don't bank on it. But you definitely can build that into your numbers. And if that, I think that it's all context too, right? Because for some people, if that was their only strategy and the only thing they held, if they buy their first property at negative $350 a month, they're probably getting out of the business real quick.
It's definitely context. This is something that works for me personally right now.
Where you're at.
Having more cash flow as a base, and looking at the options that are out there and just readapting and shifting gears. But if someone is just listening to this and they want to get in and, think that would be a good strategy for them, it may be if they have a career, like if they're a dentist or a lawyer or something, if they don't need the cash flow, if they already have, a pretty decent net worth, then that is a good strategy for them as well, right? Because it's like, essentially what it's doing is parking my money. It'd be parking someone's money.
Well, and it's protecting it from the inflation thief.
You're hedging against inflation.
Yeah.
Right? Like, I don't want to just leave it in the bank or even gold. Like, why not put it in a hard asset that has in a city that has market fundamentals that point towards appreciation?
Yeah, gold and silver are an insurance policy, and it bugs me because they don't actually generate return, right? They just they insure against loss of value, but and that's not even a guarantee. But in the long run, it sort of is. It seems to me anyway. But yeah, of course, real estate's better. You want to know the real kicker, the thing that really bugs me?
What's that?
So inflation, the government's kind of stealing your money by printing more.
Okay.
But you get taxed on your asset going up in value, which was caused by inflation, which was because of the money they were stealing from people.
Right.
So you're basically getting taxed on something like, in terms of real buying power, if say your house went from 600 to 900, but only, well, let's just say that was all due to inflation.
Yeah.
You would get taxed on a $300,000 gain if you sold it, right?
You would.
But why would you get taxed when when your real buying power for that dollar value has not changed? You can't buy more.
I see your point. It's just that you are capitalizing, though, on the other hand, on the compounding, returns annually.
Yeah, you're paying down. You're going. Yeah, it's going up. Relative to what you put into the property, you're good. Hey, I'm not complaining overall. I'm just saying that it's probably something not a lot of investors have thought about.
Definitely, it's just totally outside your control. So I don't really think about it.
No, I like that though. You just stay focused on
what's within your control. Yeah.
What's within your control, and I think that makes a lot of sense. So Gurpreet asked a question here. Hello, Andrew and Carlo. My name is Gurpreet. I am looking to get started and looking to purchase my first property. I am currently renting out and paying only $650 for rent. Well, that's actually pretty good.
Yeah.
My question is, should I buy my principal residence and house hack, or should I go ahead and get an investment property? Living in Mississauga or Brampton, I would still be paying $2,000 to $2,500 out of pocket, even if I were to live in the basement and rent out the upper unit. On the other hand, I can buy a cash flowing investment property in areas like London, Sarnia, and Windsor. What are your thoughts? Thank you.
I mean, I think it's a great question. Personally, I'll let you tackle it after maybe. I think that if it's his first property, which he said it would be his first, it makes a lot more sense to just straight up buy the cash flowing property. Unless he has that's from a numbers, real estate perspective, growing your business perspective. Unless he has some other reason that he wants to move for, privacy or freedom or whatever the case. But from a perspective of, he said he's trying to get into real estate, I would say definitely start off with cash flowing properties, even your first, 3, 4, or 5. If he can get into a cash flowing property right off the hop, then I would say do that, because he mentioned he'd be out of pocket like $2,000, even if he house hacked. So definitely I would say cash flowing property, scoop that cash flow for a little while, see if you can replicate that and move out when you need to move out. Like, to put into context, I think I had like 4 or 5 rental properties before I actually moved out on my own. So that's what I did, and that's what I would suggest he do as well. Yeah,
to that point, I have never owned the house that I lived in.
There you go.
To this point.
There you go.
I did that because I knew I could get mortgages. If I had a giant liability on my mortgage application, a giant cash flow loss on my mortgage application, I knew it would affect my mortgage ratio, so I just didn't do it. Which was a huge sacrifice.
Yeah, it's all about sacrifice, right?
Now I'm looking, to finally get our own home, amazing. And we're looking in Burlington's insane, and prices here are silly.
Yeah.
So might have to apply some guerrilla marketing tactics to find one. To the point, Gurpreet, I think I'd be looking in tertiary markets. Like, if you're already going to travel to London, what's it to go to Sarnia or Windsor, to a market that has more cash flow right now? Maybe you don't need to go that far. Maybe you can look north. I would, if it were me, I'd be looking for the cash flow market, and I would, because you're going to have to invest time. You're going to have to build a team. You're going to have to learn, learn who to work with, learn that market. Carlo, you already know London. You're not going to stray from London because, you can spot a deal a million miles away because the market.
Exactly. It's so easy. And he's going to learn whatever market he gets into as well.
Right. So do you want to focus on the market where it's a needle in a haystack to find a property that's cash flowing? Because let's face it, you can find a cash flowing property anywhere.
Yeah.
But how hard do you have to work for that? Or do you want to focus on the market where it's mostly needles and
it's a norm? Yeah.
There's a little bit of hay.
Yeah.
So that would be my thought there. Like, we're in a pickle. Like, in the area that we're in, like, I didn't want to keep driving to London because it's an hour and a half for me.
So
to Burlington. So an hour and a half. London to Burlington's about an hour and a half, hour 20.
Yeah.
I wanted to just be able to, invest in my backyard. So I was looking a lot in Hamilton, and what I kept finding is, like, prices are just silly.
Oh,
People
yeah.
are bidding wars, zero cash flow, a lot of speculation on value. The second, again, we're talking about competing with others. It's like, okay, I need to get creative.
Completely. Like one reason why I am even adapting into buying these higher end properties is I actually purchased my own property, which I'll be moving it. So I'm in the process of moving, and it costs 800K in London.
Yeah.
And I was like, for what this actually buys me, it's like between the difference of, like we discussed, 500, 600. Now I can put some money in my backyard, whatever, put a pool in, finish the basement the way I want to do it. And why would I buy something for 500 or 600 that's just like a quarter of half the house?
Yeah.
You know what I mean? So what we're saying to this young gentleman is like, yeah, go to the tertiary markets and find something that you can actually get a reasonable bang for your buck, make some cash flow. And if it's his first one, he's going to learn a whole bunch while he's doing it. He's going to learn, how to pay all the bills, how to get a mortgage, how to secure a tenant, how to deal with tenants, how to put a maintenance team in place, how to possibly manage it remotely. So it'll be great for him.
Yeah, it's a learning process. Like no matter what, it's work, and that's the thing. Like, I mean, I think you and I are both a lot less interested in hard work now. I mean, we'll do it on the right thing, but we want to focus our energy where the highest value is. But early on, you just got to learn the skills. You gotta grind it out until you know the skills, and unfortunately, that's the way it goes. But yeah, that would be my thought. I would definitely be looking at those markets. So let's see what else we got here. We had somebody ask how to find JV partners when you're just starting out. Family and friends won't partner. I know you've never been a JV guy, Carlo, but give your thoughts here based on the question asked.
So is this question saying that they've already tried with family and friends?
So Kyle wants to know, how to find JV partners. And it sounds like he's asked his family and friends and they're not interested in partnering yet.
That's a tough one, because if you didn't put that last caveat in, you almost always, when you're starting out, have to approach your family and friends, because you don't have the experience to go to an investor and say, look, this is what I've done. Whereas your parents, for example, know you as a person. They know your character, right? So if they know you're not lazy, if they know you're a hard worker, you can say like, Dad, you know me as a person. Here's my proposal. And always keep it professional,
right?
Even if you're with him. But just picking my brain here, because if he's already tried family and friends and he needs a JV,
I would ask a question back to him. Why are family and friends saying no?
That's kind of where I was going. Like, put together a more professional product to your family and friends, because they are your best bet. Like, they know you as a person. Like, if he comes to me and says, will you JV with me? Like, say, what have you done? Like, show me what you've done then.
Right, exactly. Like, how's your sales pitch? I would start with that. I mean, I've pitched people when I had very little experience, and the way it goes is if you don't have the experience, you have to make up with tenacity, with enthusiasm, with a heck of a lot of hard work and research. You got to have answers to all the questions they might ask, even though you've never done it. Hey, I haven't done it, but I've called this person, this person, this person. I've got these quotes. I've got this. I've called the city. I've done this. And then you blow them away with your level of preparation. They're like, whoa, you are not messing around. Other thing I've noticed is it's a lot easier to get a yes when you actually have a deal. Don't go to them. You can get a tentative, hey, like, would you like to hear about it? If you don't have something. And they'll say, yeah, we'd love to hear about it. That's really all you need prior to actually having a deal.
Take some balls, though, to just go out and get a deal without knowing first you have that partner.
Yeah, so you gotta figure out how to do that conditionally or something along those lines.
Or just get the damn deal.
Or just get it. Or have a plan A, B, and C, right? Like maybe you get that deal and you already got somebody else wants to buy it. If you can't do it, and you get a wholesale fee.
Andrew, just plan A.
Just plan. Carlos just plan A. I've done just plan A, but I had bad plan A's, so I guess I'm a little bit more careful. But I know, Carlo, that's based on your experience, your level of understanding too.
I think one other point that just occurred to me on that, and there's a personal example too, is if he were to find someone like you or I, or with a little more experience in the real estate field, and he offers to provide us with some kind of value add service in exchange for maybe some mentorship, then that would do him well, because at least he would begin to establish a relationship with us and a rapport.
Mm-hmm.
And then perhaps once we get to know him and his character, even though he hasn't done anything deal-wise, we may think that his aptitudes are akin to JVing with. So I have students, tenants that help me out with leases. One just helped me out building a website. And, they just want to get it. They want to get their foot into real estate.
Yeah.
So they're offering to do these things, and I'm answering their questions as well. So it's a win-win for both of us.
So it's like mentorship, right?
Yeah,
I think, like go, that would be a great suggestion.
That can evolve.
Go work for free. Go work for free for somebody who knows way the heck more than you do.
Yeah, and that can evolve.
Yeah, exactly. Then you learn, and then all of a sudden you become more valuable. When you go to pitch
100%.
somebody, now you know what you're talking about. Hey, I've been working for a real estate investor for the last, X number of months. I already have answers to these questions. And so when you go into a sales presentation, which is what it is when you're pitching a partner,
absolutely,
you get objections. The person objects, oh, but what about this? What about that? That's an objection. If you don't have an answer for that, you lose.
This guy right now, he's going to be sitting there with like a deer in headlights if someone gives him because he has no experience.
Maybe. Well, I mean, I don't know his backstory, but
that's why I'm saying like maybe get some experience, and that would be great for him. Because I know now if like there's one tenant, she helps me out with leases, and then one guy, he helps me out with showings. If they were to come to me and say, would you want a JV? I'd probably still, I don't know, I would consider it, but at least they could put me down as a contact, as like a reference. For anyone else they could JV with, right? Yeah,
and just the very fact that they can call you
is huge for them.
To actually, speak with you. Like, I mean, I can say from my experience when I was getting started with this stuff, being able to speak with you is hugely valuable.
Yeah, well, thank you. I appreciate that.
No, thank you.
No problem.
It was helpful. So it's all about kind of leveraging your resources, and of course, got to give back too, right? So the working for somebody, I think, is a great way, or finding ways to add value to that person, like you said.
Totally.
Those are great ways. So Kyle, thanks for the question. We're getting out of the box here. I haven't done a question and answer episode like this in quite a while. We did one with an accountant, which was cool, but not like
this. A lot of technical questions, right?
Yeah, it was all like capital cost allowance,
CCA,
all that stuff.
Wow.
Okay, so what city are you buying in? So actually, both of us are all in London in terms of buying. I have done a little bit of stuff up here in terms of
the question was, what city are you buying in?
Yeah, you're in London.
That's it?
Yeah, this is a different person.
Oh, okay.
Yeah, so anyways, that was an easy one. We'll just go to the next one. How do you screen your tenants for student rentals?
Yeah, so it's a pretty good question. Aside from the screening, regardless of which group that I select, I'm always going to have guarantors for each student. So typically it'll be a 5-bedroom home, and I'll have 5 separate guarantors. So that is important regardless of which group I pick. The other thing you can do to mitigate your risk in student rentals, if you want to take this approach, is if you do offer a higher end product, then just by virtue of your price, your rental price, you probably will be attracting let's say the more affluent niche in the market. And I've noticed anyways that there's a connection between those types of students wanting to take more pride in where they live because it is a nicer place. So that's another way to hedge against risks when selecting tenants. Aside from all that, what I personally do is students who are already living in places, they have groups come through and really like what they see. So a lot of my new properties that I have become available are just by referral only. So I'll send an email blast to my existing tenants and say, look, I have this coming up. And, I literally have so many groups that want to rent it that I have to pick one without even putting an ad. So if you wanted to do that, or if they wanted to have a higher end product, then I think just by having the higher end product, they're going to mitigate their risk. Mm-hmm. But also definitely always get a guarantor. You could put caps. You could put caps on utilities. You could put mechanisms in place to essentially mitigate your risk. You could do monthly checks if you wanted to on your property, or have a property manager do that. You could recommend that a cleaner go in there every month or 2 months.
Just to get eyes on the property.
Just to get eyes on the property. I know that I like to, either myself or employees, I like to actually, not employees, guys that are on my team, like to go in and actually see the property when we change the furnace filters.
Yeah.
So I like to do that a few times a year and actually check the property out, see the condition that it's in. As far as like selecting a group, it's a little bit different from the regular family rental where you run a credit check and you can call references. A lot of these folks are going to be 17, 18, 19. They're not going to have that much experience.
There's no tenant history, like nothing like that.
But I think student rentals get a bad rap. Like I've had such amazing experiences with the vast majority of groups. Total sweethearts, all the groups. And like the last thing they want to do is like damage the property or have ridiculous parties. Especially when they see something they want to take pride in, right?
Right, and that comes back to what you created, right? You created something that they could be proud to live in.
Exactly.
And I agree with you completely, and I like managing those properties better. I like the tenants in the student rentals, and I enjoy interacting with them a lot better. I think the experience goes better, and I absolutely think you're right. By positioning your product above and better than everybody else, and in a higher price point, you immediately eliminate that group that's just looking for the cheapest deal
for price.
Like kind of the market I was in when I was a student, because I was paying my own rent. Like I just wanted the cheapest one, but we didn't treat that property well, and I was trying to avoid myself in the product that I created. And I know you do that. You try and create something that's going to attract that best tenant. So the main screening, I think we can recap is have the better product, but then of course you get the parental guarantors, and I get them too. I get them on every single person, because why wouldn't you? The students are open to it. They kind of expect it. I know I've heard people say that students didn't want it. Well, I guess they didn't want the property.
It's the norm. It's essentially the norm. So,
but if you have enough demand for your property, it's like, well, this is how it goes.
I just wouldn't even accept if a group was like, no, I don't want Garrett. I say, well, that's fine, not a problem. I'll just take the next group.
Just take the next group.
It's no problem.
Clearly, there's a reason they don't want that.
Exactly. There's got to be a reason that they don't want that.
Okay, thanks for taking questions, Andrew. How do we seek bigger cash flow properties? Also financing. I'm an excellent listener and learner, but haven't yet broken out past 2 properties. Excited to make this year about growth and scaling. You're a great podcast host, and I've learned so much from your output. Thank you for that. One last note. Okay, now he's just tooting my horn. Okay, so we'll just go back. We'll just go with the first part. Okay, so thank you for that. I appreciate that, and spread the word. Get more people listening. So you have 2 properties, wants to grow for bigger cash flow properties. Carlo, if you were all the way back at 2 properties, what would you do now?
I would say, because of the climate, I don't know, did he say where he is?
I don't know where he is. I know he's in southwestern Ontario.
Okay. I would just say, because the climate that we're in right now, where it's difficult, if not near impossible, to actually find properties that are cash flowing right off the bat, like right when you actually acquire the property, I would say try and find ways to add like some creative value to the property where you can create that cash flow. I know we've touched on this point before, but if he only has 2 properties, he may not have actually like gotten into a full out renovation or a gut. So he may want to learn the renovation side of things and learn the values after renovated, really study what properties will be worth after he puts in X amount of dollars, what he'll buy it for, how much the renovation will cost, and what it will be worth. And then kind of do the reverse logistics, like on that new mortgage, on the new value, will he be able to cash flow at the new rent, at the increased rent with his renovations? Right. So that's the mentality that I had at 1, 2, 3, 4 properties. It's like, what can I add here
to get the rents
strategically? Like, I'm not looking to gut at that point, right? Because money is tight when you're trying to expand, a couple properties. So what can I add strategically? Obviously, make sure the property is safe. Like all the big items are safe, but what can I do strategically? And I would always go to, bathrooms, kitchens, paint, change out some light fixtures, do things that are going to make a visual impact, modernize the properties, be strategic in your renos. Your only goal is to get the rent up.
Right. And I think that's where you got to have, if you have somebody that you can ask that's got like a really good acuity for design, like somebody who knows how to just add that little accent that might not cost that much, but can make your place stand out And I know, like, obviously we do what we can, Carlo, and I know we do nice stuff. But I had Carmen on the show, and she'll put in 50-year-old light fixtures into a brand new place.
I love what she's done here. I mean, she obviously has a good eye for that stuff.
Yeah. So she has a great eye. Like, I'll watch what she does, and she's usually like, a couple of years ahead of where the market's going. So she's already doing, what we know will come in a couple of years, or what we think it will.
Okay.
So she stands out. I've seen her get higher than market rents,
Totally.
where people didn't think it was possible. And then as soon as you're getting those higher than market rents, now appraisers can justify giving you a higher value.
Right. It's all based on that income.
As long as especially if you get into the multifamilies, when you're getting higher,
it's all
five units,
rate.
it's all cap rate, right? So it's all how much income your building produces. So it becomes very mathematical what they're going to value your property at. I mean, nothing's perfect. There's no perfect science, and you could find an appraiser that won't agree with this, but many will. And I think that's a big potential. So in order to do that, though, if you don't have a lot of cash,
right,
you may need to leverage your existing house, your existing two houses, maybe use private money, have a really good plan, and really know your market, know that end value.
Yeah.
And then you need to execute and go like crazy.
And it depends how motivated he is, how far he wants to go. He could do the work himself. You could hire buddies. I mean, you could, barter with buddies. It just depends how badly he wants it. Right. But the end goal, as you and I both said, I think, is look for opportunities to create that cash flow, that value, and then exit, and essentially a BRRRR. Yeah.
So I had a guy on the podcast, Jeremy Ivany, back on episode 78 for anyone who wants to check that out.
Okay.
He went to a real estate conference, decided he was going to get in, and this was 14 months ago. And he got to 7 properties just between his girlfriend and himself.
Yeah.
Inside of, I think it was like 10 months. Now they're at 11 properties, including JVs.
Good for him.
In 14 months.
Good for him.
Doing BRRRRs, and he was doing the work himself. So he's still doing it. Jeremy,
here you go.
Shout out.
Yeah, I mean, so if there's a will, there's a way.
There's a will, there's a way. Now, Jeremy's an electrician by trade, but quit his job, and now he just works in his properties, and they do all the renovations, hires out a little bit. He's got his angle doing Chatham, Ontario, so there's cash flow there.
Oh, okay. Okay.
It's all what you're willing to do, right?
Yes.
If you're single, I feel like you have the ability to do these things. Once you're in a relationship, you're kind of tied to an area a little bit more than you might be,
So don't get in one.
Not saying don't get in one, but if you aren't in one yet, take advantage of that time and use it to your advantage.
I mean, you have utter freedom at that point to move around, be more selective with the markets that you deal with, and put in more of your time.
Yeah.
I mean, if he wants to, for me, it's like, I want my time. Yeah. Like, I'd rather pay the money, keep my time,
right.
But for him, it may make more sense to put in his time and sweat equity and, create that cash flow.
Right. I honestly wouldn't mind, like, if I could just put all my other responsibilities out of my life, I wouldn't mind doing hands-on work, framing a house. Like, I would find that fun. Like, just,
if you enjoy it,
I wouldn't want to always do it, but I would like to do some of the work myself, just because I don't mind working with my hands.
Yeah, I just don't find it mentally stimulating. So, I mean, if you enjoy it, then you do it.
I wouldn't necessarily want to do it every day, but
I hear you.
Like, I do have aspirations of, like, have my own house, build my own addition, or even build my own house one day and do some of the work myself. I think that would be fun.
That's cool.
Because I could tell the kids one day that I built.
Because time, it has more value than money, basically. You can't get your time back. Like, why do people pay $20 for a Chipotle, whatever, stir fry? Because I don't want to go cut the lettuce and cut the meat and, like, go to the grocery store and, take the money. I'll keep my time.
Yeah.
Right? Like, I'll pay. I'm not going to go cut all that up and waste an hour.
Well, and it's also knowing what your time is worth, right? So if you're asking the question, if I'm doing my highest and best use, my most profitable activity, how much money can I earn?
It's not boarding drywall.
Yeah, exactly. Because that's like a $40 an hour job.
So the way I think is, why would I do that? Unless I really enjoy it, which I don't. Why would I do it?
Exactly, right? So if that's a $40 an hour job, but you could be, say, selling real estate or doing something like that where you can make $100 an hour or $200 an hour, then you got to acknowledge, well, unless I enjoy it, it's not productive.
Correct.
Yeah.
Correct. Not efficient.
Yeah. Not efficient. That's a good way of putting it. All right. I think that was it for my questions. So I actually want to ask you about, you have a property that you just built an addition on.
Yeah.
And I won't give the address, but it was already an 8-bedroom.
Okay. I know the property. Yeah.
Okay. Can we talk about that property?
Sure. What would you like to know?
Okay, so what did you do to it? Originally, you had I think you had 8 bedrooms rented out.
Yeah. So in London, the cap, most people know this, but the cap for the number of bedrooms is 5. So legally, you can only have 5 bedrooms in a house. This particular house, it was essentially grandfathered in, so to speak. So I have 8 bedrooms that are in fact legal. Great property, one of my best properties, very close to the university, and very spacious house. Amazing. It's always been good to me. But huge lot, like football field lot, right? And I always thought this space on the back was way underutilized. So a couple of years ago, I think all municipalities in Ontario came out with a bylaw. But in London, basically,
it was 2017, right?
Yeah,
London, yeah.
Yeah. In London, you could build additional units on the essentially you can convert your property into 2 units, either by building another unit in the back or making the basement another unit, as long as you don't build more than 40% of the existing structure. So in this case, it was a large house, almost 4,000 square feet. So I was able to build 40% of that, so about 1,600 square feet, which I did. So essentially what I did was convert 2 of the bedrooms in the main house to dens, and then build another 2-bedroom unit on the back.
With a den.
With another den. So it turned out great. I actually matched the brick. We're just finishing it up right now. And that's the type of thing that I'm passionate about, because it's creative, like we were talking about earlier. So if you look at that project in isolation, it's like that cost of the secondary unit is around $200K. Okay. The other ones that you and I did, I know were a bit less, but this is bigger, and I did it with brick.
And it's bigger, yeah.
Okay, so around
that's it. $200K. You're doing well at $200K.
Probably low 2s.
Yeah.
So just say $200K.
Yeah, sure.
With the additional revenue that's going to get, I'll rent that for $2,300 or $2,400 a month.
So if you think 1% rule, you're beating it or matching it.
And even if you say the taxes are going to go up by another 200, and utility, even say a net of around $2,000, and so 24,000 a year net income, and then the cost won't exceed 240. So that's like a 10% cap. Crazy. So you can't find that anywhere else, and that's only as a result of knowing the market and being creative.
Yeah. Okay, so let's just look at what this house would generate then. So you're going to have, on the existing house, what will the gross rent be?
On the existing house, it's going to jump down to 6 bedrooms rather than 8.
Okay.
But way more competitive at that point. So I think I'd be at around the same that you're getting for Sunset at $850.
$850 a bedroom.
Times 6.
Okay, and then you're going to have $2,400 on the back.
Yeah.
Okay, so you're going to be about $7,500 a month
on this property. Yeah.
On the property.
Yeah.
What do you figure your taxes will be?
Taxes right now are about $6,000 a year. They might go up to $7,500.
Yeah. Okay. I just had MPAC stop by one of my properties.
Did you?
Yeah. Don't like that.
No.
Okay, so you're probably going to be like $3,000 in insurance.
Yeah, say $3,000 insurance. Yeah.
Okay, maintenance 5%. I'll leave in there. You don't have management. Your utilities, you're going to be paying some, right?
Yeah, definitely paying utilities. You got to put around $500 a month for that.
So $6,000 in utilities, and then lawn cutting. I think you're going to have
say $100 a month. Lawn, snow removal.
$1,200 a year.
Yeah.
For that. Okay. So what do you figure that's worth when you're done?
I don't plan on selling it. I wouldn't even accept, 1.3, 1.2. I wouldn't even accept that. I think it's worth 1.4-ish.
1.4. Yeah. Pretty crazy cash flow. But yeah, so at 1.4 million, that would be a 4.8% cap rate, which I think sounds appropriate.
We're all essentially one brand new, and the existing house is almost all new as well.
So hypothetically, if you were to refinance that at 75% of 1.4 million, you'd have $1 million, $1,050,000 mortgage.
Yeah.
25-year mortgage, that'd be a $4,500 payment at 2.25%.
Yeah.
You'd still have $1,000 of cash flow.
See, that's the power of getting into real estate and just hanging on to it. Mm-hmm. And that's, so that situation now, I think I owe maybe $300 or $400K on that, but it's just sitting there if I wanted to refinance.
So you have $300 or $400K even after this. So let's just see what your cash flow approximately is. You have a bank mortgage on that right now?
Yeah, I have a bank mortgage.
Yeah, so that's like, you probably have 25 years left on it maybe at this point.
Something like that.
Something like that, 2 point some odd
It's
percent.
like the mortgage is
Yeah.
like less than $2,000. It's like nothing.
So once this is done, you'll have basically $3,700,
Reasonable
$3,800
cash
a
flow,
month.
which I'll just keep, unless I really found other projects and I needed those funds. But I would just hang on to that. But it's not like I wasn't projecting that sort of equity when I bought it. Mm-hmm. And I'm projecting that same sort of equity now going into this different strategy that we talked about earlier.
Yeah.
So if you do really understand the market and you have that awareness and foresight, you can set yourself up to be in really good equity positions not too far after your acquisition date, like 4, 5, 6, 7 years.
Well, you never know for sure. But
you never know for sure. No,
I like your London strategy because like just think about the people leaving Toronto right now because their employer no longer requires them to work in the office every day.
Totally.
Like, yeah, you know what? London's a lot cheaper. I only need to come in once a week. It's a 2-hour drive. Big deal. Something like that, or come in once a month, or I don't know. Everyone has a different scenario, but I think you could attest to this. Like people are flocking to London right now. The demand in London is insane, crazy seller's market.
Yeah, and not to mention if we see the rapid bus, transit system come to fruition between Toronto and London and Windsor and all these GTA. Yeah. It's like what's going to happen to London values then, or Windsor or Burlington or whatever the case, Oakville. It's like they're immediately going to go up 20-25% when that occurs.
It's pretty wild. Now, I don't know with our income disparity how much more houses can go up across the board, but for sure, London's on the cheaper end
still
of all of Canada.
And it's still, even on the cheaper end,
for big cities.
The polarity in the discrepancy in who can buy a house and who can't is even strong in London. So in Toronto, it's essentially like owning a house is becoming just a dream. For most, let's say you graduate university, you're 17, 18, 19, whatever, 20, 21. Owning a house is a prospect that isn't really realistic in Toronto anyways, for most people. Yeah,
it's true. I think I heard somebody had put out an article that said you needed to make $200,000 in Toronto a year just to be middle class, to be considered middle class.
Yeah, that makes sense.
I feel like it's even higher than that now because this was a little while ago.
That makes sense.
Can you imagine?
And you're certainly not going to be lounging up in Yorkville or anything like that. No,
what is that? So they say, quick math, 4 times your salary is what you can afford to buy. What can you get in Toronto for $800,000? A condo?
Not even the dirt.
A condo? Not even the dirt.
Yeah, I mean, you can find a little condo, maybe 800, 600 square feet, 700 square feet.
Yeah. I do, my viewers and listeners will know, I do think that's going to come down. I don't know how much. I just see a lot of forces, right? You see Toronto and there's just too many reasons why people could leave now. I don't think that means forever. I just think for a time being, there actually might be a really good opportunity to buy in Toronto.
I think now, at this time, there is.
Yeah, it's becoming quite a buyer's market for condos anyway. It's just slowed. I've seen that since we just sold Jordan's condo. We've seen it slow. So we were,
So it was a good move.
Yeah, I saw it coming and I just said, okay, let's price aggressively. Let's price under the market so that, we're not competing. We're clearly under and we got an offer. When she finally dropped the price enough, we got an offer first day. I think it was first or second day. And that just firmed up. So
amazing.
Yeah. So you gotta again, take the emotion out of it and just really look at it logically and say, wow, there's a lot of reasons, people can work from home. There's no sporting events. Airbnb just flooded the market with rental properties, which when those don't rent,
a hit now too.
Huge hit. So Airbnb is basically outlawed. So now those are going to get liquidated. A lot of them are going to go up for sale when people realize they can't cash flow. So, it's not ideal, but I do think there's some opportunity there.
Yeah,
for sure.
I think the bottom line of everything we've been discussing is pay attention to these outside factors and look for creative ways to purchase real estate. Like look at what's going on in the economy on the macro, the micro level, pay attention to where your own strengths might be, leverage your own assets, your own family, your own friends, if you can, and use your own strengths and what's within your control and optimize those to the best of your ability. And don't really worry so much about things that are outside of your control other than to put them into your calculations, but don't concern yourself with them.
All right, Carlo, anything else you would like to cover before we wrap up?
I had one question that made sense that perhaps we could cover.
Oh yeah, you had some questions too.
I had a bunch come in, but one made sense. It's like, what are some of the mindsets that would be akin to actually maintaining your own business in real estate and then growing your own business in real estate? Do you have any input on that?
Maintaining and growing?
Yeah, like just what mindsets would be beneficial to actually owning properties and trying to grow and become, financially independent?
Well, yeah, I think that you need to be questioning things first off, right? And I think most real estate investors have. They question the original traditional plan of pay into your Canada pension, eventually you retire. Like obviously we're well beyond that. But I think you're probably better to answer that question. But I'll just give my 2 cents. Like I think that you got to condition your mind mostly daily. Like what goes in really does affect you. So I mean, I don't really watch a lot of TV or anything like that. I mean, I do a lot of audiobooks and podcasts, and I like to educate myself. So I think that you got to be in that growth mindset. Educating yourself, getting around people that think the way you want to think, and that's we're buying properties, we're managing. So if somebody has a connection to you, like they should be utilizing that, seeing if they can add value. Be a giver, and you'll get back by delivering value to others.
Yeah, I think the only thing I would add is definitely build on your point, like your circle of friends or your sphere. Like they say, you're the product of the 5 people you hang out with.
Yeah,
I could not agree more. So as far as mindsets and whatnot going back to the original question, I would say in the business of whatever business you're in, you're going to encounter hard times, right? It doesn't matter if it's real estate or any business, but a quote that I heard a really long time ago that resonated with me was like, hard times never last, but hard people do, or tough times don't last, but tough people last. And I couldn't agree more, because I've been hit with really difficult times in my own business, and I'm sure you have. And I'll just throw out a personal example, tell a story. But a few years ago in the summer, I had 3 projects on the go, and they were all in the summer, and they were all going to be flips, and they were all student properties. So they all had to be completed by September. And the City of London went on strike, which was hard enough as it is, because I needed to complete those projects for the students to move in. Also, there were sales in place. And also, the flipping business in general is just extremely capital intensive.
Yeah.
So I was counting on that, like money that was coming in, roughly like $1 million liquid coming in to acquire the next batch of properties.
Yeah.
So already it was hard enough finishing the properties. I got them done. And then what happened was all 3 purchasers couldn't complete their financing.
Oh, okay.
It had nothing to do with the properties. Like they were complete, the students were moving in, but they couldn't complete their financing. So the purchasers had to back out. It's not as if the realtors that I work with wouldn't find new purchasers, because they did. But just during that time,
just a time lag.
During that time, to couple all that, I basically had to discharge the 2 mortgage. One was just paid in cash, but there was 2 mortgages that I had, and the lender, the private lender, had other commitments at the end of the term, so I had to pay those off.
Yeah.
So it's like, not only am I not getting this money, but now I'm in the hole because I have to pay these mortgages off. So you helped me out during that time. We put a private loan. But what I'm saying is that the mentality, like 95% of business owners, what would they do during that time? They'd probably bow out. They'd probably take a victim mentality. City's on strike, these buyers. But I think a mentality to keep in mind is like, you're not really going to ever grow and become mentally stronger unless you experience those situations.
Yeah.
If you're always in your comfort zone. So when that was happening to me, I already had that awareness. And I'm like, you know what? I actually like this. I wouldn't ask for it, but I like that it's happening now, because it's an opportunity for me to actually be challenged and get creative, do what I have to do, and just move on.
Yeah, get stronger.
So I would say keep that mentality and have a stomach for these types of things, for rejection, things like that.
The nice thing is you were already in. There was no looking back once you were in. You already own those properties mid-renovation, right?
I was already in.
So yeah, I mean, a lot of people, if they'd had the foresight, they would have said, no way, not doing that. So it's almost kind of a blessing that you didn't know it was coming.
I still would have done it.
You still would have done it? All right, well, there you go. Not everybody would. You're right.
But yeah, that's about it. I think that was a good question, so I wanted to touch on it.
Absolutely. Actually, I have a question for you.
Okay.
Very relevant. So this is our rental season coming up. It's almost October now.
Yes.
By the time this airs, it will be.
Yeah.
Normally, I'm sending out emails to tenants, sending out next year's lease.
Yeah.
Is anything changing on that front for you, knowing now, like Western is mostly not in-person classes right now?
And you're sending out next year's lease. Where'd you learn that from?
I learned that from you.
Okay.
So anyway, so we're asking Carlo here what he would do, knowing now the lockdown situation.
I'm not going to change my approach.
So you're just still going to reach out to them and still say,
hey. I think there are still enough students, despite what's occurring, that A, either have classes, or B, do not want to be at home. Yeah. They want to be off campus. So I'm not changing my approach.
So you're just sending it out anyway.
Yeah, I feel good about that.
Yeah, I have, like, I can speak from my student rentals. I think they're all back. I don't think, like, there might be like one student in each house that's not there.
Right, but fundamentally the house, like the majority of the houses are all back.
Yeah, and I was just talking to one of them the other day, and he's just like, yeah, I just didn't want to be at home.
I was talking to multiple, two girls the other day. They're like, no matter what, I don't want to be at home.
Yeah, exactly. And so it's good to have them looped in. I know like some people, for instance, in Windsor, their rental cycle is typically September 1st. Is when they start, which I don't like. I would want to get that back to May 1st. Because then in their last year, they're just going to bail out on the last 4 months.
Yes.
But anyways, a guy I know, he was renting his out. He was proactive. He dropped his price just so he could
incentivize them a little bit.
Yeah, incentivize people because there was less demand. But I think that it's coming back. I think a lot of people are pretty optimistic about, next year.
Of course. I mean, like the campuses all exist. It would be really far-fetched to imagine that classes would continue not to go on, but who knows?
No one knows anything for sure. I'm hoping for the best. So yeah, I'm going to do the same. Just going to send those leases out. As far as marketing for new student leads, do you see that being an issue?
I still use my same approach. So I reach out to all my existing tenants and send an email blast. And I actually incentivize them as well. It's like if you send me a referral that materializes, I think you may have incorporated this as well.
I haven't yet, but I've heard you talk about this, and I think it might be time.
It works amazingly because it's a win-win. I get tenants that are actually friends of existing tenants. So
do you do it for ones that are on their way out, or do you do it to just, like, say you have house A that's in one location and house B that's in another location? Are you going to send an email to house A saying, I'm trying to fill house B? Do you have anybody?
So I'll actually send an email to all of my tenants, even past tenants, with all of my availability for the season.
Say I have these houses. If you have anybody.
I don't even necessarily list the houses. I just say I have 8 houses or 9 or 10 houses, and I'll give you like X amount of dollars per referral. Like right now, I'm giving $1,500
for a group. So if they refer a group that signs.
Yeah. So you could potentially make, like last year, I think I had a guy make like at least $6,000 or $7,000.
Really?
Yeah. Just by shooting over referrals.
That's amazing.
Yeah. And a girl made like $3,000 or $4,000 as well, just by, hey, here's my friend, an email. Yeah. That's it.
They want a house.
Yeah. They want a house.
So are you still doing like off-campus housing listing?
Very rarely.
So, okay. So I'm going to build this into my business then too. worth the hour for that alone. All these things, right? These little systems you can do to just make your life easier.
More efficient.
Yeah. Just more efficient, get better results.
Totally.
And then referrals, typically they're going to be of similar caliber to the people that referred them.
They always have been in my experience. And then the referred group really has a little more of an onus to keep the house tidy. Yeah. It's because they don't want to give a bad reputation to their friends, right?
I love that.
So it's a great system. I love it too.
That's great. Okay, I'm definitely integrating that into my system for this year. So it's coming up, right? We're on October 1st tomorrow. So as we shoot this, but this will air end of October. But
cool.
Carlo, thanks for doing this. Where should people follow you, reach out? Should they just wait for the next episode?
First of all, you're welcome. My pleasure. They can email me if they want, or actually, like I said, I have a website where they can check out the type of product that I have.
Yeah, what's that
you
website?
You can link it below. It's ehlondon.ca, so just exclusive homes.
ehlondon.ca.
Yeah.
Okay, yeah, I'll get that link from you, put it in the show notes, and then I'll put your Century 21 Connect. You are a realtor, although I don't believe you're actively taking on clients at this moment.
No, I'm not taking on clients, but yeah, I do have my real estate license.
Yeah, it's a handy tool.
Very handy tool
when you're in this business.
Yes.
So, okay, thanks, Carl. Appreciate it.
You're welcome. Thank you, Andrew.
Thanks for tuning in to today's episode. Just a friendly reminder that the kindest thing that you can do if you're enjoying this content is to share it with somebody that you think it could help. I don't have a big marketing budget for this podcast. Everything is word of mouth. So your sharing this content means everything. Thank you again. I'll look forward to seeing you on the next episode.